Okay. Good afternoon, everyone. So you're welcome to our class. Just to mention, this is a combined class um, for FR and SBR. So our SBR students are joining this class because it's also a requirement for them to know as well. Even though we are still going to solve more advanced questions for their level, but the core principles remains the same. The core principles remains the same. So today, for the FR students, we are going to start and finish IAS 12 on income taxes. And what does IAS 12 look at? Basically, the focus is on tax. And you all know that the tax is a compulsory levy on all residents of a nation. In fact, including non-residents that makes income from the jurisdiction. So it's more of, especially with this tax reform, it's more of a taxing your income. So basically, that's tax. But the focus of IAS 12 is on tax that is paid on profits. Hence, it deals with company income taxes and withholding tax. You know that withholding tax is also a company income tax. It is just an advanced payment of tax. It is an advanced payment of tax. That's why you're able to claim it as a credit when you want to pay your CIT. So what I want to teach you today, all the principles we'll be discussing today, has nothing to do with the tax you pay on the goods you buy, the tax you pay on your salary. No, we are not looking at how to account for personal income taxes, for capital gains taxes, for yeah, capital gains taxes is also a tax you pay on profit, so it would apply, it will apply, but VAT will not apply. We are not dealing with all of that. The focus here is company income tax and withholding tax. So what I'm teaching you to today is basically how to account for those two. Now, having said that, firstly, when we say income tax, what do we then mean? So income tax is an aggregation of current tax and deferred tax. In the sense that when you put together your current tax and your deferred tax, then that is what we call income tax. So today, we want to look at two things. First is current tax, and second is deferred tax. So let me pick it one by one and explain it in detail. When we say current tax, This is a tax that is payable or recoverable. Yeah, it's possible for you to recover tax. It's possible. Okay, in respect of taxable profit. So any tax that you pay or any tax that you can recover in respect or on your taxable profits, that is your current tax. So if you make a taxable profit of 100,000 and the law says pay 30%, CIT, pay 4%, development levy, when you sum those two together, that is current tax. Is a tax that is payable or recoverable in respect of taxable profits. Again, just to fulfill and erase any technicality, let's look at what taxable profit is. So this is a profit that is determined using the tax law enacted or substantively enacted in the jurisdiction. In the jurisdiction, taxable profit are determined using the tax law. No doubt around that. Therefore means that taxable profit is different from accounting profit. It's different. They are not the same. So accounting profits, so this is a profit before tax determined in the statement of profit or loss. So that profit before tax that we determine in the statement of profit or loss, that one is accounting profit. You don't pay tax on that. We need to determine taxable profit for you to pay tax. It is on that you pay tax. And I'm aware, because I know that those of you doing tax and those of you doing advanced tax, I know that Mr. Chris has already taught you or is teaching you adjusted profits. Also, I know that Mr. Idris is also taking you adjusted profit. So you already know to a large extent how to determine taxable profits. Now, then there is deferred tax, which is the second one. This is the tax that is payable or recoverable in respect of temporary differences. Deferred tax is the tax that is payable or recoverable in respect of temporary differences. The technical thing here is temporary differences. See, this is the difference between the amounts recognized in the accounting records and the amount captured by the tax authority for tax purposes or to determine the taxable profit. So usually we'll find out that it is not all items that we have in our accounting records. It is not all our expenses and income that the tax authority will capture when it's determining its taxable profit. Ordinarily we would expect that the taxable profit and the accounting profit should be the same. The fact that they are different, that difference is arising from temporary differences, but not just temporary difference. There are permanent difference too. That is why I didn't define temporary difference as the difference between accounting profit and taxable profit, because it is not all temporary difference. There are some that are permanent difference, which I would mention in a jiffy. Again, I said temporary difference. So this is the difference between the amounts recognized in the accounting records and the amount captured by the tax authority for tax purposes, or amount captured by the tax authority to determine the taxable profits. So the difference between the two is what we call taxable profits. And you see, the amount recognized, in the accounting records is known as carrying amount. You'll see me calling it carrying amount. While the amount recognized, I wrote accounting records again. Okay, while the amount recognized or the amount captured by the tax authority for tax purposes is known as tax base. Hence, temporary difference can be seen as the difference between carrying amount and tax base. Okay, I'm going to stop here for now. So when I go deeper into deferred tax, then we're going to speak more to this. But for now, I just need you uh, to take it to heart that the amount recognized in our books is not in totality what the taxman will capture for determining his taxable profits. There are some amounts you will not capture for now. There are some amounts you will not capture for now. So, or there are some you will not capture fully. Those differences are temporary difference. So we can see it as the difference between carrying amount and tax base, because the amount the taxman captures is the tax base. The amount we have in our books, in our accounting records, is the carrying amount. Okay, I just wanted to, so these are key definitions that are paramount to this topic. Now, let me come back to accounting for current tax. When I say accounting for current tax, I mean the recognition and measurement of current tax. So, how do we account for current tax? You see, we have already established from my earlier explanation that current tax is the tax that you pay or recover on your taxable profits. Hence, to determine current tax for us here will be given because either a taxman or your tax consultant or the tax department will get it for us. So if let's say we have um we have 2025 financial year, this year that just went, 2025 financial year, and we have a taxable profit of um 150,000 for 2025 financial year. The reality is this: the tax on this 2025 financial year can only be paid in 2026. And this is because the tax law requires that all companies should file tax returns 6 months after the end. And all relevant taxes, that is income tax, that is CIT, must be paid within that period. So the situation we will find ourselves is that as far as this 2025 financial year profit is concerned, the tax will be paid in 2026. Okay. Now, let's say since the taxable profit is 150,000, that means in 2026, the current tax will simply be, let's say we use a 30% rate in that jurisdiction. That means our current tax would be, how much would this be? This would be 45,000. Yeah. So our current tax is 45,000. Now, usually when this current tax is determined as 45,000, we usually call it a provisional tax. Okay. This would be a provisional tax in the sense that, or an estimated tax, in the sense that that's your own computation. That is your own computation. Okay. Just for the purpose of filing returns. This would be a provisional tax or an estimated tax. And it will be captured to be recorded in the 2025 accounts using an audit journal or a journal as it were. Because this tax is usually determined after the year end. It's not during the year transaction. As far as 2025 account is concerned, it's determined after the year end when we have closed the books. Because of that, we enter it through journal. And the journal entry we pass, the journal entry is as below. So it comes in as an expense. So we'll have, it's part of income tax expense. And you haven't paid it, we'll have a current tax liability. And you know that anything expense is usually debited, and anything liability is usually credited. So you're going to debit expense in your P&L with 45,000, and you're going to credit your tax, your liability with 45,000. All this, so then your account is complete. You then publish your account, you file it with the tax authority along with your tax computation and all that. Then, after you have filed, you're expected to pay immediately. And you know that in Nigeria, filing is done on Tax Pro Max, and you can pay your tax immediately there. As soon as it's to compute it, then you file, then you pay. So when they pay and they come with receipts, they give it to you, the IFRS expert. You are the IFRS expert. So when this tax is paid, it is recognized as below. So first, you are going to nil off the current tax liability because now we have paid the tax and we are going to credit bank. And don't forget, all this is happening with 45,000. That's the tax that you have completed. And I told you that that is an estimated tax. Now, it should end here ordinarily. It should be over here. But the reality is this. Few months after, see, few months after filing and and paying of the tax of 2025 financial year, which we call 2026 year of assessment, the tax authority it will come up with a desk review report showing their own computation of your tax liability. So they will come up that, okay, we have looked at your financial statement, or we have seen your computation, or so this is our own computation. This is our own computation. So it comes up with this computation. Let's assume that, okay, it's a long process. You go there, you provide documents, you do this, it's a lot. So let's say, so the tax liability was finally agreed at 55,000 naira. You know, this is now the actual liability. And you know that all this is going to be happening in 2026 in respect of 2025 taxes. So with this now, so with this agreed tax liability, there is, so let me put it very simple for you. So the company is now required to pay an additional tax of how much? Who can tell me? I haven't heard your voice since we started. So with this agreed liability of 55,000, so how much tax, additional tax is the company required to pay now?
10,000 naira.
Good. Good. I needed to be sure that you're following me. You're following the story that I'm telling you. So now, this 10,000 naira, you as accountant, we call this an underestimation for tax. Underestimation for that's what we call it, or under provision for tax. Remember, I told you that the tax that you have computed or your tax consultant has computed, I said is a provisional tax or an estimated tax. So the real tax is the one you agree with the tax authority. So on the basis of that, we would know whether we had that estimation before that we did before, whether we had underestimated or overestimated. In this case, we had underestimated. Now, we need to put this in our books. How do we put this in our books? So this amount would be recognized and paid immediately. So usually this is not an amount that you would usually accrue for. Yeah, you can accrue for it. Yeah, no problem. As soon as you get your demand notice, you can accrue for it, but it's something you pay immediately, right? So let's assume it's paid immediately. Then usually we would debit underestimation for tax. That's the name of the account head. Okay. Usually it will also be under income tax expense account, but you describe it as underestimation for tax because it's an additional tax. You can credit tax liability or you just credit bank. Okay. If you credit liability, then when you pay it, you debit liability, you credit bank. So the liability goes off, right? So credit bank with how much? With the 10,000. Now, there is no doubt that this 10,000, when you're preparing your 2026 account, it will be shown in your P&L as part of your income tax expense. To be shown in your P&L as part of your income. That means when you determine the tax of 2026, you add this as part of it. You describe it as underestimation for tax, so that anybody looking at it will know that this one is not a tax of 2026. So this is a tax relating to 2025 as a result of underestimation. It's a common thing in tax. This is how we do it. This is how we clean our books every year for taxes. It's allowed, right? So when you see tax, that tax line in your P&L, it usually includes a lot. It will include tax of this year. It will include under or overestimation for tax of previous years and all of that. So, and this is the process flow for current tax. That is all. It's not more than that. So, and I'm giving you an example for underestimation because that's the reality. You will not find a situation of overestimation when the taxman will come and say your tax is 40,000. They will rather not bring the reports. You will just see that they will not come back to you again. When they discover that, whether mistakenly or in whatever way you had overpaid, they will not bring out any reports. They will not say anything. They'll just be looking at you and move on, right? So I don't even expect ICAN to even come up with overestimation. If they do, it's the reverse of this, right? It will be a credit. You credit overestimation for tax instead of debiting it. I would not say debit bank because they will not give you your money. They will not. So you would rather debit a current tax asset. The law says that they should give you. You can use it to offset future taxes like that. So usually you would debit a current tax asset in the case of overestimation. So let me just note it for you. In the case of overestimation, You simply debit current tax assets and credit over estimation for tax, which is the income, the account head, income tax expense, POL. And that is all for taxes. That is all for taxes. Now, I need you to have something at the back of your mind. This is really important. Let me write it in red. This is very important. So, no, I don't like this one. Yeah. So, note. So, the principle in IAS 12 is based on matching concepts. It's based on matching concept. In that, in that, in that, the taxes for the year should be matched with the transactions for the year, whether or not those transactions were paid for or were captured by the tax authority. So the idea of tax of IAS 12 is based on matching. So the idea is that the tax for the year should be matched with the transactions for the year. We believe that every transaction has a tax implication. And the tax, any transaction that occurred this year, you must match it with the tax, meaning the tax must be recognized this year. So whether or not those transactions were paid for or were captured by the tax authority. Okay, so you need to recognize it that year. Make sure you put it in your books that year, right? And also, additionally, if an item is recognized in SOPL, meaning statement of profit or loss, the related tax should be recognized where? In the SOPL. However, if an item is recognized in the OCI, meaning other comprehensive income, the related tax should be recognized in the OCI. So that's matching. So if the item is in P&L, the tax on it should be recognized in P&L. If an item is recognized in OCI, the tax on it should be recognized in OCI. And that is how these items really work as far as taxes. And why I will not mention that if an item is recognized in statement of financial position, the tax should be recognized. Taxes should be in P&L. Taxes are expenses, right? So you pay tax on profits, and that's what we are dealing with. So it's only that P&L or OCI. That's where the related tax. Just that any item that goes to OCI will end up in equity, right? Does that mean this tax also will end up in equity? Oh, yes, because the net of it goes to equity as it were. So it will end up in equity there. But this is the idea of IAS 12. It's based on matching concepts. It's based on matching concept. Okay. So that is all for current taxes. That is all for current taxes. So let's solve some questions. Oh, let me explain deferred tax so I know that I'm done with my explanation. Let me just explain deferred tax as well. Then we can then solve questions. So now, you know that I've already explained to you, I've already explained to you what deferred taxes are. Okay. So you know that I stated above so that deferred taxes are payable or recoverable on temporary differences. Now, and I mentioned that these temporary differences are really difference between the carrying amount, which is what we recognize in our books, and the tax base, what the tax authority capture for the same amount, what they capture for the same amount. Let me give you examples. Examples of temporary differences. Number one is depreciation and amortization. What am I saying? And capital allowance. In your exam, they will call it tax depreciation because, yes, we call it capital allowance in Nigeria, in our own country, but IFRS will call this capital allowance, they will call it tax depreciation because it's not capital allowance, they call it in all other countries of the world. Okay, so they just call it tax depreciation. So when they call it tax depreciation, you should know that, okay, you're talking about capital allowance. So usually, um, what we compute in our books is depreciation. What the tax authority will capture in respect of this depreciation is capital allowance. So it's usually different. That difference, we capture it as a temporary difference in the books. We capture it as a temporary difference in the books. And this capital allowance, what the taxman will recognize for you, especially in the old tax law, is usually much more. Is a lot. They can give you initial allowance 50%, annual allowance 25%. So it's a lot. Then subsequently, it will be small, small, small. So the reality of this difference is that ultimately, over the life of the assets, all of them, the amount will be the same. At the end of the life, the amount will be the same. So that is why this difference is really temporary. It's just temporary. It's just difference for each year for now. All right. So we don't like that difference. We need to, it's affecting our books one way or the other. So it's not making us to capture the actual tax effects. So so we call it, we are capturing that temporary difference. Just give me 1 minute, please. Okay, so one of the temporary difference is the fact that we capture depreciation and the tax authority captures capital allowance. I was telling you that the reality is that at the end of the day, the total of everything at the end of the period of the asset is still going to be the same, right? Just that each year they are capturing different amount. So we need to balance out the tax implication of that. We call that temporary difference. Another example of temporary difference is when we have provisions, provisions, provisions. So in this case now, it could either be provisions for doubtful debts, or it could be provisions for maybe warranties, or provisions for maybe director's fees, whatever provision that you're making in line with IAS 37. Anytime you make provision and you put it in your books, the taxman will not capture such provision. The taxman will say this provision, it is not, it is not, it is not necessarily incurred. They will say you have not paid for it. They will say you have not incurred it. When you have provision that you are making a provision that your customer might return some goods to you, that you are giving them warranty, that they might return, and you need to incur some money. The taxman will say, okay, have you incurred the money? Have they returned it? So how would you allow? Taxman will not allow it. But if at the end of the day you then pay it, that provision you made last year, maybe in subsequent year you now paid it. The taxman can then allow it. So that's a temporary difference in the sense that we have captured it in our books this year, but the taxman will not capture it until you have actually paid for it. So I'm capturing it this year. The taxman is going to capture it much later in the future, in another year. That's a temporary difference. That's a temporary difference. So I need to, which is what I was explaining here, that we need to ensure that all transactions that occur for the year, we need to capture the tax effect, whether or not the transaction were paid for or were captured by the tax authority. So this provision, even though the taxman will not capture it as a deduction for tax, but we need to consider the tax implication of it. We need to consider it. So that's why we call the tax implication of such item arising from temporary difference, we call them deferred tax. So that's why we separate it, that, okay, oh, this is the current tax. This is one that ourselves and the tax authority has agreed for the year. These ones are the deferred. These are the ones we did not agree. But we will agree. We will be on the same page. It's just a temporary differential. It's just a temporary disagreement. But as far as accounting is concerned, we need to calculate the tax. Since the transaction occurred this year, we need to consider the tax. We need to factor in the tax. So we call it deferred tax. But it's there in our books as a tax. Whether we are paying it this year or not, it doesn't matter. So that's another example of temporary difference is provisions. Any provision, taxman will not allow it. So it results in temporary difference. Another one is accrued expenses. This is a similar explanation to provision in the sense that there's an expense that you have incurred, but you have not paid for. The taxman will say, bring evidence of payments. They will say, bring evidence. I mean, if they eventually allow it, you sweat. So this also, if they refuse to capture it, then it becomes a temporary difference because they will say, okay, if you pay it, we'll capture it. That means they will capture it much later, right? So there's a temporary disagreement between us. They are not going to capture it for tax. So that means it is not going to reflect in current tax. For that reason, we need to bring it under deferred tax. Another one can also arise from accrued revenue or revenue recognized on accrual basis. When I say revenue recognized on accrual basis, it means that you have not actually received the money. You have not received the money, but you have recognized the revenue, right? It might result in a temporary difference between you and the tax authority. The tax authority might say, okay, we are not taxing it. We won't tax it since you have not received the money. When you receive the money, then we will tax it. So there's a temporary differentials between the two of you. Another one is prepaid expenses. Expenses that you have not incurred, but you have paid for, like rent, that you pay. You can pay 2 years in advance. The taxman will allow the entire 2 years. They are ready to allow it for you, even though you have not captured it in your books as an expense. It can result in temporary difference should they allow the entire amount for you. Even though in reality, since it's only 1 year we'll have captured for the year, that is the only one they would put. That's the only one they will allow in most cases. But I'm just using this to explain, to make you understand what we mean by a temporary difference. So they will say, okay, since you have paid everything, we'll allow it. Then you would, until you put it, you won't have everything in your books. So there will be difference between your records and what they have captured. Another one is revaluation surplus. When you have a revaluation surplus, whether you revalued upward, the taxman will not allow it. The taxman will tell you that where is the gain? Where is the money you made? Have you sold the assets? They will not allow it. They will not tax it. So when you eventually sell the asset and make money, then it will be taxed. So there is a temporary differential between the two of you. The same explanation can go for fair value adjustment. When there is changes in fair valuation, either fair valuation of an investment property or fair valuation of a financial asset, when you fair value an item, the taxman will not, if it's a loss, they will not allow it as a deduction. If it is a surplus, they will not also tax it until the actual cash impact is felt. They will not allow you to put it in your books. Finally, is tax losses carried forward. Tax losses carried forward. This is also would result in you in a temporary differences for you because they are not going to, when you have a tax loss or when you have a loss for the year, you will not pay tax for this year, and you might not even pay tax in the future. Okay, so it would make or result in some differences as well. Now, having mentioned that, you need to then be able to distinguish it from examples of permanent difference, because these are the ones that we will recognize deferred tax on, this temporary difference. But this permanent difference, those ones has no tax implication. And examples are items that the taxman will permanently disallow. It's not because of probably maybe you have not paid it or you have not earned it. This one, they would permanently disallow it. So it's naturally not considered for taxes. So there is no need making any deferred tax for that, because you are never going to pay tax on it or recover tax on them. An example is fines and penalties. When you have fine and penalties in your books, the taxman they will disallow it. Some entertainment expenses, the taxman would disallow it. Or probably you make a donation that is not to a recognized body, the taxman would disallow it. So these ones are majorly expenses or any other expense that are permanently disallowed for tax purposes. Any expense that are permanently disallowed for for tax for tax purposes. Yeah. So that is explanation on sorry, just give me okay. Now we have tried to establish the whole idea behind deferred tax, and we know now that it's majorly all about trying to ensure that we capture the tax impact of the transactions that happen for the year, even if the taxman does not capture it in his current tax. We still capture it for accounting purposes. We call that deferred tax. And those items that the taxman will not capture, we put them together in something we call temporary differences. And this needs to be differentiated from permanent difference, because those ones have no tax impact at all. So there's no need to. So that's why I separated those ones. Again, additionally, so again, the same way you have current tax liabilities and current tax assets. So we have so deferred taxes, okay, can either be a deferred tax liability or a deferred tax asset. And from the name, deferred tax liability. So this arises from taxable temporary difference, where we will pay additional taxes in the future. So from the name liability, if a deferred tax results in a liability, it means that that temporary difference that I've been talking about is a taxable one where we will pay additional tax. And from the example I gave you, examples are this one now. This one you will pay additional tax in the future. It will result in a taxable temporary difference because the taxman is not going to tax it now because he says you have not received the money, but you will tax it in the future. So that's your disagreement. Is a disagreement where you will pay additional tax. And when you will pay additional tax, that is what we call a taxable temporary difference. Also, is this revaluation surplus where you say you have made a gain, but the taxman says, where is the money? Where is the money? The taxman will not tax it now. But that your disagreement will make you pay additional tax in the future. That is a taxable temporary difference. It usually results in a deferred tax liability. On the flip side is deferred tax assets. And this arises from deductible temporary difference where we will get tax deductions, where we will get tax deductions in the future. That's the simple language. We will get tax deductions. Like, for example, an expense that you put in your books that the taxman says that, no, I'm not going to allow this because you have not paid for it, but you have it in your books. That difference will make you have a deduction in the future because when you eventually pay for it in the future, you will enjoy it as a tax deduction. That is a deductible temporary difference. Also, is provisions. When you make provisions, the taxman will not allow it. They will tell you you have not paid for it. It is not a real expense. That difference between the two of you will make you have a deduction in the future when the taxman eventually allow it. That is a deductible temporary difference. Deductible temporary differences result in a deferred tax asset. However, deferred tax assets can also arise from tax losses carried forward. Tax losses carried forward, because when you have tax losses that you are carrying forward, it will make you have tax deduction in the future. Also, is unused capital allowances. If you have any capital allowance that you have unused, you are going to carry it to the future. It will make you have tax deduction. But IAS 12 says that, know that deferred tax assets are recognized to the extent that the entity will have sufficient taxable profits against which the deductions can be allowed. So what we are saying here is this. accounting is based on prudence, it's based on substance. We are saying that, yes, you are saying you have an expectation that you would have a tax deduction in the future, but will you have the sufficient profits in the future against which that deduction can be allowed? So usually, if a company makes loss for the year or it makes accounting loss for the year or in previous years, such company cannot recognize deferred tax assets because we will say on the basis of the fact that it makes loss for the year means that it will make loss, even though that might not happen, but that's the only basis with which you can judge this. So you can only recognize a deferred tax asset to the extent that the entity will have sufficient taxable profit against which the deductions can be allowed. Otherwise, no, you will not be allowed to recognize such um, deferred tax asset. And this is the entire length and breadth as far as income tax is concerned. This is the whole of the explanations. So now let's solve questions. Okay. Do I have Shidera here? Shidera reads for us. I don't know if she's in class.
I'm here, sir. Good afternoon.
How are you?
I'm fine,
Okay.
thank you.
Okay. So can you please read for us? I think you're in a noisy place, are
Okay.
you?
No, not really.
Okay. All right. Please read.
In 2017, Lawal Limited has taxable profits of 60,000. In the previous year, 2016, income tax of 2000. The income tax on 2016 profit has been estimated as 15,000. The corporate income tax rate is 30%. Required, calculate current tax payable and the charge for 2017 if the tax due on 2017 profit was subsequently agreed with the tax authority. Ask A, 17,500, B, 12,500. Any under or overpayment are not settled until the following year's tax payment is due.
Thank you very much. So now, this is a question um, on current tax. So you will see that we are in 2017, and as far as 2017 is concerned, we have a taxable profit of 60,000. But last year, in 2016, the income tax on 2016 profits, the tax on 2016 profits, we estimated 15,000. Okay. And the tax rate was based on 30%. We're now asked to calculate the current tax payable for 2017. If the tax due on 2016 was subsequently agreed with the tax authority as A, 17.5, B, 12.5. So no doubt, what the question wants us to do is the current tax payable and the charge for 2017. No doubt that's what they want us to do. So the estimate of tax, the estimate of current tax for 2017 best is my tax rate multiplied by my taxable profits of 2017. That gives me 18,000. However, I need to make some adjustments for 2016 taxes because adjustments in 2016 usually happen in 2017, like I've explained to you, because in 2016 last year, our estimate for current tax for that 2016, the question told us that we estimated for 15,000. So the examiner says that they gave us scenario A. So the tax agreed with the tax authority, meaning the actual tax that they eventually agreed, which is what you would pay at the end of the day. The taxman, they give us scenario A, that is 17.5, which means that you need to pay an additional tax of how much? Of 2,500. You need to pay an additional tax of 2,500 because in 2016, you estimated 15. The taxman says no, it should be 17.5. So can somebody tell me what name did I say we call this tax? What name do we call it?
Underestimation.
Temporary difference.
No, temporary difference. Bow. Underestimation. Underestimation for tax. Because we had underestimated for tax. That's the name we call this 15. I'm sure the person that said temporary difference didn't join us from the beginning. So this underestimation for tax is going to be considered this year. Who can remember? How do we recognize this in our books? What did I tell you is the double entry for this?
We debit underestimation for tax and credit bank.
God bless you. Olamilekan. We debit underestimation for tax and credit bank. You see, this is an additional tax. This will be recognized in P&L as an expense, meeting added to this current tax also, which is an expense. That means our income tax expense for that year is going to be how much? 20,500. That goes to P&L. I hope you know that the current tax payable is not 20,500 because this 25 is paid immediately. It won't be a liability for 2017. It was a liability for 2016 that Dex audit brought out, and you need to pay the tax immediately. This is not a payable for 2017 year end, except if the company did not pay it. Except if they did not, they were just owing it. And that one is something else. You should have paid it. So it's assumed you should have paid it. So the payable for 2017 is this 18,000. This is the one that goes in as a current tax liability. So the current tax payable or liability is 18,000. But the current tax charge that goes to P&L or income tax expense that goes to P&L is the 20,500. Because our liability for the year is actually 18,000, not this. This you pay it immediately. In like manner, the second scenario, so I just copied it. The only difference is this. Here, what we agreed with the tax authority is 12,500. Okay, so there's still a difference of 12,000, 2,500, but in this case, it's going to be overestimation for tax. And I told you that in this case, you credit bank. What am I saying? In this case, you're going to credit P&L over estimation for tax, and you're going to debit current tax assets because they should give you back the money, but they will not give you back. That's why we are debiting assets that we're going to recover it against our future taxes. Okay, we'll recover it against our future taxes. So we're going to debit assets. But that credit to P&L will offset the tax for this year in such a way that our income tax expense to P&L becomes 15.5. Though our liability for this year that we are going to recognize as a liability is still 18,000. The current tax charge to P&L will be 15.5. But in this case now, there will be a second leg. Since the tax man will not give you the money, so we would have a current tax assets of how much? 2.5. Okay. In accounting, in fact, IAS 12 mentioned it specifically that don't offset. Some people argue that since we have 2.5, why not offset 18,000 payable against the 2.5 assets so that we will have a net liability of 15? No, we don't do that in accounting. So you need to let us know your liability for this year. Then separately disclose this one too, so that we'll see, okay, you're expecting 2.5 from them. Okay. So, in fact, let me mention this, that note that offsetting is not, let me say tax offsetting is not allowed except in these cases. Moses, I can see your hand. Sorry, I just want to quickly finish this point. Okay, when an entity has a legally enforceable right to offset. So if there is a court case, the right to offset what they are owing you against your liability, right? Then you can go ahead and offset. You can go ahead and recognize the net amount in your books because you have a court directive for you to do that. Okay, so you have a legally enforceable right to offset, or where the transaction or the taxes, where the transaction or taxes are set up to be settled on a net basis. So if it's such that you have agreed with the tax authority, whether you wrote them a letter and they have agreed that you can go ahead and offset or settle the net, there is a documentation to that effect, then you can offset that. Instead of presenting liability and assets separately, then you can present a net liability of 15.5. Otherwise, don't. You cannot. Except you have a legally enforceable right, or this transaction is supposed to be settled on a net basis. Okay, so that's the end of this question. Okay, now please go ahead, Moses.
Yeah, sorry, I have a question in the area in respect of offsetting.
Okay.
In a situation where you have a receivable and a creditor at the same person, with the same person, is it allowed for you to just pass a journal, the same amount, the same person, to pass a journal to set it off? That's number one. That's number one. Then secondly, in the area of deferred tax asset, Please, is it possible for you to just explain a little bit for me again?
Okay. All right. So we don't offset in accounting. Hopefully, I'll teach you IAS 1, ifrs as soon as possible. It's spelled out there that offsetting is not allowed. And there are some areas where offsetting is allowed, like when you are computing carrying amount, for example, now that you do cost minus depreciation. So, or you want to get net realizable value. Now you do sales minus cost to sell. Or you want to determine gain or loss on sale of an asset. That you do cost minus, you compare the sales proceeds with the carrying amount. You see, those ones are not offsetting. Those ones are just determining measurement. When you have separate transaction, you treat them separately. When you have different transactions, when that you are expecting money and you're supposed to pay money to the same person, they are different transactions. You present them separately because that's fair and that's faithful representation. Again, for deferred tax assets, we already explained it that it arises from deductible temporary difference. Those temporary difference where you are going to get a tax deduction in the future. For example, provisions, where you recognize the provision and the taxman says, no, I cannot allow it now. I'm not going to allow it for a deduction now, but it is in your own books anyway. But the taxman will allow it in the future. So in the future, you will get a deduction. We call that deductible temporary difference. The tax on that is called deferred tax assets. There are other items that result in deferred tax assets, like tax losses carried forward. When you carry forward tax losses, the tax law requires that you can use it to offset or to reduce your tax in the future. So that is also a deferred tax, and because you will get a tax deduction in the future. That's a deferred, it results in deferred tax asset. The same thing for unused capital allowances. They are usually deducted against your profits in the future. So you are getting tax deduction in the future. So it's a deferred tax asset. However, I said note that you can only recognize deferred tax if it is certain that you are going to make a taxable profit against which those deductions can be allowed from. If you cannot show us that you will make a taxable profit, then you cannot recognize a deferred tax asset. And that was what I explained on deferred tax assets, and I hope I've been able to help you, Moses.
Thank you very much, sir. Very clear, sir. Thank you.
You're welcome. Now, let's solve another question on current tax. Okay. Chidera, are you still there?
Yes, sir.
Okay, please read this for us, question 2.
Question 2. In the accounting year to 31st December 2017, Remi Limited made an operating profit before taxation of 55,000. Income tax on the operating profit has been estimated as 25 1,500. In the previous year, 2016, income tax on 2016 profit has been estimated as 17,000, but it was subsequently agreed at 20,250 naira. A deferred taxation liability of 8,000 will be made in 2017. Required: A. Calculate the tax on profit for 2017 for presentation in the accounts. B. Calculate the amount of tax payable. Thank you.
Thank you very much. So, again, the first one asks us to calculate the tax charge. Calculate the tax on profits that we put in our P&L, which is the tax charge or the income tax expense. So in this case, my tax estimate for the year, or my estimate of current tax for 2017 was how much? Was 22,500 as given, right? And I will then make adjustments for 2016 current tax. Because the estimates of current tax in 2016 was how much? 17,000. Then agreed with the tax authority was how much?
20,250.
20,250. In this case, do we have an overestimation for tax or an underestimation for tax?
The estimation.
We have an underestimation for tax, which is a debit. Olamilekon told us that time that we debit this to P&L. That's why it's always added. And we're going to credit bank. So we'll have 3,250, which means that our income tax expense that goes to P&L for 2017 is the addition of these two, which is 25,750. However, the current tax payable will be the estimate of current tax. No, that's not all. I forgot that they gave us a deferred tax liability here of 8,000. Okay, so when there is a deferred tax liability, there will be an expense leg. There's a deferred tax expense of 8,000 as well. So let me call this my current tax expense since it hasn't separated. Then my income tax expense that goes to P&L will be the addition of these two, which is 33,750. So what goes to my current tax payable? I'll have my estimate of current tax, which is my 22,500 for 2017, and also my deferred tax liability, which is 8,000. So my current tax payable is 30,500. 30,500. Okay. And that's the end of this question. Now, let's solve another one. Question 3. Shidera,
Hold
this
for a
way.
moment, sir. Hold for a moment, sir. Just
Okay.
1 minute.
Okay. You want me to show this one?
Hold it at that B part, sir.
Okay.
Solution to B. Yes, just 1 minute.
Okay. Okay, while we are waiting for Edward, can you ask a question, Michael?
Good evening, sir. Good evening, our facilitator. And thanks for the in-depth analysis. So my question is around the deferred tax liability that was added. So our prior knowledge is that the current tax, the tax that is charged to P&L is current tax and movement in the deferred tax. So now we were given 8,000. So I'm guessing that we are assuming that at the beginning of the year that the deferred tax liability was 0, so it increased to 8,000. That's why it was added. I don't know whether that was the assumption, since we're supposed to be looking at the movement in the deferred tax component. Then the second aspect of my question, I don't know whether we'll still get to it at the later part of the lecture, is around when you look at some company financial statements, we see a line item that is called minimum tax. We do not see it for most companies, but for some specific companies. I don't know whether you can just throw light on the minimum tax, and is it compulsory for it to be shown as a line item on the face of the P&L? Thank you.
Yeah, Michael, we have asked a very good question. That shows that you have a prior knowledge on this before now. So I've not even mentioned anything about movement yet, because I've not really solved any question on deferred tax like that. I've just explained temporary differences. I've explained deductible temporary difference, taxable, deferred tax liability, and all that. So I explained the major principles around that. So that's why when they gave us deferred tax liability for the year, the double entry by default for the year is debit P&L and credit liability. So since they didn't give me any other information, I don't want to bring in what I've not mentioned. So by the time we solve questions, then I will then start introducing the idea around, okay, deferred tax is a position item, and at the end of each year, it is recomputed. So we capture movement between the beginning and the end to P&L like that. But since you have that prior knowledge before, yes, of course, that means we didn't have any opening for that year. It was 0. And at the end of the year, we had a deferred tax of 8,000. So movement goes to P&L. But substantially, the double entry for deferred taxes is debit P&L, you credit deferred tax liability at the year of origination. Then subsequently, the liability component is being carried forward, then in such a way that you're capturing increase or decrease in such deferred taxes. So thank you for asking that question. It will help other students also with the response I've given to you now. Furthermore, you asked about minimum taxes. So in IAS 12, they didn't mention anything about minimum tax. It did not mention anything around that. We did not care the nature of the tax, whatever the tax authority or the tax law calls it. We are only concerned about the amount of the taxes you're paying on your profit, and we account for it. relating to the year it is meant for. If it is for the current year, we account whether it's minimum tax, whether whatever it is, whether it's development level, whatever it is, whether it's education tax, whatever it is, we don't really care about that. They are all corporate or company income tax, and we recognize it the way I've explained to you as current taxes for the year. So for tax law is 0.25% of your turnover, of your revenue. I mean, I don't remember it very well again because with the new tax reform, a lot of things have changed around that from the future going forward. But it's not something we put in as a line item for accounting. We just put current tax is current tax, income tax is income tax. So the underlying result that will be showing in your tax computation. But very good question, Michael. Okay, now let's solve one more question on current tax. Shidera.
Question 3. For the year ended 31st July 2014, Kiki Limited made taxable trading profit of 400,000, on which income tax is payable at 30%. A transfer of 10,000 will be made to the deferred taxation account. The balance on this account was 50,000 before making any adjustment for items listed in the paragraph. B. The estimated tax on profits for the year ended 31st July 2013 was 40,000, but tax has now been agreed at 42,000 and fully paid. C. Tax on profit for the year to 31st July 2014 is payable on 1st May 2015. D. In the year to 31st July 2014, the company made a capital gain of 30,000 naira on the sale of some property. This gain is taxable at a rate of 30%. Required: A. Calculate the tax charge for the year to 31st July 2014. B. Calculate the tax liabilities in the statement of financial position of Norman Kiki as it 31st July 2014.
Thank you very much. I'm sure there are people that read for me in my class don't fail. They always pass from experience. So should keep it up. So we're talking about that we should calculate the tax charge for 2014 and also tax liabilities that goes to statement of financial position. So you want us to calculate the tax charge for 2014. Now, again, similar to what we have been doing. So this is 2014. Our taxable profit is this. Our income tax rate is 30%. And a transfer of 10,000 will be made to deferred tax accounts. The balance on this account was 50 before making an adjustment for items listed in this paragraph. So this is what Michael was talking about. So this is a deferred tax where the opening was 50,000 and we are making a transfer of 10,000 to it. So this is the additional for the year. Okay, so it is the additional for the year that we are debiting P&L and crediting liability with. So 10,000 goes to P&L in income tax, and the liability becomes 60,000. It increases to 60,000. Aside that, we were told that the estimated tax for last year was 40,000, but we agreed 42,000 with the tax authority and fully paid. In fact, if they don't tell you that it's fully paid, you should assume that it's fully paid because it should be fully paid. So they will give you a few days as soon as they give you a demand notice, it's something you pay instantly because penalty interest will be accruing. They don't want to delay it. The best you can do is to write to the tax authority that, okay, you want to pay the principal, then you want to pay the interest and penalty later, or you can apply for a waiver, but it's something you pay immediately. Number 3, so tax on profit for 2014, you're supposed to pay it next year. Yes, that's how it happens. Finally, they said at the end of 2014, there was a capital gain, and the rate of tax is 30% on that. Okay, this is not far from what we have been doing. So first, for the estimates of current tax for 2014, they didn't give us the amount, but we can calculate it as 30% times 400,000. And this should be 120,000. Then let me bring in my adjustment for current tax of 2013. And this adjustment for current tax of 2013, the estimate of current tax for 2013 was how much? Was 40,000. Okay. Sorry. So as I was saying, the estimate of current tax for 2013 was 40,000. So amount agreed with the tax authority. How much did they agree with the tax authority? They agreed 42,000 with the tax authority. So ultimately, we have an underestimation for current tax of 2,000. And also, which of course will be added to the tax for 2014. Then we'll have a deferred tax expense that was transferred of 10,000. This one that was transferred, 10,000. And also, there was a capital gain tax because he made a gain. So we have a capital gain tax, which is 30% times the gain. And the gain is 30,000. So 30,000. And that's 9,000. So we would have a total of income tax expense of how much? What do we have? 30, is that not 41,000? That's a tax charge. Then we'll also calculate the tax liabilities for 2014. We'll have our current tax liability, which is how much? This 120,000. That's the liability in respect of current tax. We have deferred tax liability, which is now 60,000, because we transferred 10,000 to the existing 50,000. Transfer 10,000 to the existing 50,000. We would also have capital gain tax Yeah, they were not told it has been paid, and it was computed as 9,000. So my tax liability is 189,000. That shows under my statement of financial position. Okay. Now, before we solve questions on deferred taxes, I just want to show you the disclosures for tax, for income tax. Okay, Ayobami, please go ahead before I go to my next discussion.
Good afternoon, sir.
Good afternoon.
Okay, please can you scroll up to the A part of the question?
Okay, I'm there.
No, of the question. Okay, so my question is coming from that A part, which says a transfer of 10,000 naira was made to the deferred taxation account. And like you have said that the for deferred tax, we have the deferred tax asset and deferred tax liability. So, but I want to know why we just assume that this is a liability, or can we assume it's a deferred tax asset also? That's my question.
Okay, yeah, that's a very good question. So, in this case, you would always assume it's a deferred tax liability. You assume it's a deferred tax liability because um, it's mostly intended to be a liability as far as the exam is concerned, except otherwise stated. So by default, I just pick it up as a liability.
Okay, thank you.
Yeah. Okay. So when you see income tax in P&L, why I'm actually showing you this, they can ask you that what are the component of tax expense because when you that income tax expense, you need to disclose the component of them. So they can ask you in the exam. So when you see the component, at least by default, you should know two. You should know there is current tax and you should know there is deferred tax. Okay. And in addition to that, you should know there is adjustment recognized for previous periods. Okay, for current tax of prior periods. Those adjustments that I used to make for like this one I did for you for 2013. So if you can know at least that three, okay, there's current tax, adjustment for prior period, then deferred tax. Now, for deferred tax, you can now break that one down into three or four. Instead of saying deferred tax, you can say deferred tax originating from temporary difference, deferred tax originating from um, um, tax losses carried forward or unused tax credits like that. So that would give you like 5 points in the exam. So I'm just keeping it even simpler than all the technical items written here for you. So we'll have the current tax, adjustment for current tax of prior period, deferred tax arising from temporary difference, deferred tax arising from uh, tax losses that's carried forward, deferred tax arising from unused tax credit or unused capital allowances. So also, as part of our disclosure, we usually do a tax reconciliation. We do a reconciliation because we are supposed to reconcile the amount you put in as tax expense, and if you do 30% of your accounting profits, reconcile where there is any difference between the two. You're supposed to show us why can't we do 30% of profit? Because accounting, the rate of tax is 30%, right? So if you need to do a numerical reconciliation between your tax expense and that's the product of accounting profit multiplied by the applicable rates. So that we will understand why there are differences. And also, you would then reconcile the effective tax rates with the applicable rates. Because you find out that in a lot of companies, when you compute the effective tax rate, you see that it's not going to be equal to, it will not be up to 30%, and it might be more than 30%. And with the tax law now, there's a provision, there's a provision there that then allows, in fact, he has said that he now has a minimum effective tax rate. Do any of you know, based on the new tax reform now, it says if you are paying a tax less than so much amount or an amount, then you need to update it to a minimum tax of how much, of which rate? Is there any of you that knows? Nobody? I'll read it up. So, and there are other disclosures here, but the one I know they can ask you in the exam is this components, and understand that we usually do reconciliation of income tax expense with if you multiply 30% by accounting profits, it won't be the same. So reconcile it, and also reconcile the effective tax rate. Effective tax rate is by the time you multiply your tax that you actually calculate all upon your PBT. That's your effective tax rate. And the applicable tax rate is 30%. You see, you need to reconcile that as well. So, okay. So that is that. Now, let's solve some questions on deferred tax. Shidera, question 1.
Okay. A machine costs 5,000 naira. For tax purposes, depreciation of 1,500 has already been deducted in the current and prior period. The carrying amount is 2,005. What is the deferred tax?
Okay. So in this case now, let me show you how deferred tax is actually determined. So a machine costs 5,000. For tax purposes, depreciation is this. Showing that this is the tax depreciation, showing that this is the capital allowance. This is the capital. When you say for tax purposes, depreciation is this. So this then does not mean accounting depreciation anymore, but rather it means tax depreciation or capital allowance. So of course they will have deducted it, but they told us that this is our carrying amount. So this is how for instances like this, I told you that deferred tax is based on temporary difference. So at any point in time, when we want to determine deferred tax, the first thing we do is to ascertain our temporary difference. That's what gives rise to deferred tax. Temporary difference is usually the difference between carrying amount, which is what we have in our books, and tax base, which is what the taxman captures. So for situation like this, the difference is arising between capital allowance and depreciation. So the way we work it out for our case is for the carrying amount is usually cost minus my accumulated depreciation. They have given it to me in this question 25 as 25. And the tax base, I can easily determine that, which is 5,000 minus tax depreciation, which is 35. So in this case now, there is a temporary difference. There is a temporary difference here. there is a temporary difference of 1,000. Now, this temporary difference, will it be a taxable temporary difference or a deductible temporary difference? Because that is how we're going to know whether it will be a deferred tax asset or liability. And don't forget, when we say taxable temporary difference, it means that a difference that would mean I will pay additional tax. When we say deductible temporary difference, it means a difference that I will pay, not I will pay, I will have a deduction in the future. So with this now, am I going to be paying additional tax or will I have a deduction? So since for me, 2.5 is what I'm deducting, okay, in my books, and the taxman is deducting 3,500. That's what the taxman is deducting. So, or in this case, this is what the taxman will deduct. In this case now, it means that I would have an extra deduction of 1,000. I'm going to have an extra deduction of 1,000. So this 1,000 therefore becomes a deductible temporary difference because I'm going to have an extra, because this is the temporary difference. I'm saying that this is my 2.5. This is depreciation that I will deduct 2.5. That's what the carrying amount means. The depreciation that I would have in my books. But this is what the taxman will deduct, 3,500. So we figure that I'm going to have an extra 1,000 in the future as an additional deduction. So this is a deductible temporary difference. So meaning I will get a deduction. And that means I'm going to have a deferred tax asset, which is 30%, given the tax rate of 30%, multiplied by 1,000, and that is 300. Okay, that is 300. And you know that this 300, I'm going to debit, in this case, my income tax to P&L. But since it's an asset, it's not going to be a debit, to be a credit. Income tax it will not be an income tax expense. It will be an income. Then I then debit my deferred tax assets with this 300 naira deferred tax. Okay, Victoria, I can see your hand. Ask your question, please.
Good evening, sir.
Hi, how are you?
Sir, they said for tax purposes, depreciation of 1.5 has already been deducted, and you deducted it again from the tax base, like from the cost and then the depreciation, like to get your tax base. But they said already that it has been deducted in the current and prior period.
Yeah, yes. So since it has been deducted, that's what I just did to do what they said has been done. So this is the cost of the assets. So for tax purposes, the taxman has allowed you 1,005 as capital allowance. So, if you're doing tax, your tax base is your cost minus your capital allowance. So since they have allowed this as deduction, so I have to deduct it from my cost to get my tax base. That's how we get tax base for assets. So when I do that, my carrying amount is also cost minus my accounting depreciation. But since the since the question already gave me my carrying amount, so I don't need to do any calculation anymore. But here, they didn't give us tax base. If they wanted to give you tax base direct, they will give you 3.5 because they will have deducted, this has already been deducted, means they have allowed it for you from profits in your P&L. Okay, they have allowed it for you for tax computations, right? So as a result of that, the tax base, what is remaining for you for deduction in the future is then 3.5. So I take away what they have given me from the cost, remaining 3.5. As far as my own books is concerned, I believe I have 2.5. So good enough for me. We have a temporary difference of 1,000, and the taxman own deduction is much more than what I've captured in my books. So I'm having a deductible temporary difference resulting in a deferred tax asset. So that's how we determine tax base. And yes, this one is confirming that this is the capital allowance they have allowed as deduction for you. Is it clear?
Yes, sir. Thank you, sir.
Yeah. Yeah, Ayobami, please go ahead.
Okay, thank you, sir. So my question, okay, what I want clarity is these deductible temporary differences. So for me, since I'm saying that the carry amount is higher than the tax base, and like I've explained previously, that when the when the tax authority maybe come with their own assessment, the company is going to be the company will pay more. So I just want more clarity on this deductible temporary difference.
Yeah. So in this case now, the company would have more deductions because as far as capital allowance is concerned, it's something they give you as a deduction. So for the sake of assets, the way we define the temporary difference is not just comparing depreciation and capital allowance singly, like that individually, but rather we look at what's my carrying amount, which is cost minus my own depreciation, okay, which is my carrying amount. And the meaning of this is, okay, this is my own depreciation that I will charge in the future. This is my own depreciation that I will charge in the future. This is my carrying amount. The tax authority, this is the capital allowance they will give you in the future. This is the capital allowance they have not deducted. Okay. So for assets case for assets, you would then be able to identify that the taxman is ready to give me more than what I want to charge, which is 2.5, by 1,000. So the taxman is going to give me more deductions. Whenever I can see that I will have deductions. So this one is always interpreted in this way. When we look at other ones, those ones are quite different from this guy. But the reality is that for deferred tax, it's more of the deduction you will get or the tax you will pay as a result of differences in amount captured in our books and that of the tax authority. So the interpretation of this 3-5 year is the deductions that we get in form of capital allowance. The interpretation of this carrying amount is the depreciation I will charge. I can see here clearly that the deduction I will get from the tax authority is higher and above what I will charge by 1,000. Therefore, I'm going to get more deductions, resulting in a deductible temporary difference that I need to capture today. And I will calculate deferred tax asset on that. Because more deductions means I'm not paying more. It's a benefit to me. And that's an asset now. So I do 30% times 1,000, which is 300. Then I pass the journal, my books, like that. Okay,
All right, thank you, sir.
You're welcome. Let's look at further questions. Now, in this case now, they are talking about not machine anymore, but interest receivable. Interest receivable. So when you have interest receivable, we are talking about an interest that you have not received, but which you will receive. So the interest receivable amount, they told us in our books is 1,000. Okay. But as far as tax is concerned, they said the revenue on these interests, the related interest revenue, will be taxed on a cash basis, meaning that the taxman will not tax it now until I receive it. So the taxman is saying this 1,000, oh, I'm not going to tax it because it's still receivable. They believe you are recognizing this income on an accrual basis. So I'm not tax. They say I'm not taxing it. So not that I won't tax it, but you will tax it on a cash basis. Now, again, we need to compute the deferred tax. Then first, we need to ask ourselves, what is the temporary difference? So the temporary difference is the carrying amount, which we have been given as 1,000. They have given us as 1,000, and the tax base, which is what the taxman is going to is capturing. And here, as far as here is concerned, the taxman is not going to capture it because the taxman says, I'm not going to tax it now. I am going to tax it when you receive it. Look at it, the related interest revenue will be taxed on a cash basis. So for that reason, this is going to be 0. The tax base is 0 because the taxman is not going to tax it. So I'm going to be having a temporary difference of 1,000. However, I need to establish that this 1,000, is it a deductible temporary difference or a taxable temporary difference? Since the situation is such that I will pay more tax in the future, I will pay more tax in the future because this revenue will be taxed in the future. So it is a taxable temporary difference. So that's the secret to ensuring you don't make mistakes. It's just for you to know, am I paying more tax or am I paying less tax? In this case now, I'll be paying less tax because I'm getting more deductions. I'm getting more deductions from the taxman. That's why it's deductible. In this case now, this is based on what they have told me here, that it's going to be taxed on a cash basis. So the taxman did not capture anything, but I'm going to pay more tax. Okay, so it's a taxable temporary difference. That's when the taxman will capture it. So here, it will be a liability. Taxable temporary difference results in a deferred tax liability And that's 30% also times 1,000. And that's 300. And for deferred tax liability, you debit your income tax expense. You credit your deferred tax liability. You credit your deferred tax liabilities. Question 3. A trade receivable have a carrying amount of 2,000. The related revenue is included in taxable profit already. Okay. So for this one, my temporary difference is my carrying amount, which I was given as 2,000, and my tax base. In this case now, the taxman allowed it. The taxman has included it. So it's 2,000. So there is no temporary difference here. There is no difference. We captured the same thing. There is no temporary difference. There is no need for deferred tax here because we captured the same amount. The next one, dividend receivable from a subsidiary have a carrying amount of 5,000. Dividends are not taxable. So in this case, my carrying amount or my temporary difference here, I will have my carrying amount, which is how much? I was told is 5,000. What's my tax base? In this case, the taxman did not capture it because dividends are not taxable. Dividend is not a taxable item. So there is a difference of 5,000, but this difference is a permanent difference. Because the item in question are not taxable. When you have an item that is not taxable or an item that is never allowed for tax purposes, that difference is not temporary. It's a permanent difference. And for permanent difference, there is no deferred tax consequence. Since there is no tax effect, so there's no need to accrue for tax, because what we are doing is accrual for tax, recognizing the tax impact. So there is no need for that. It's a permanent difference. Also, a loan receivable has a carrying amount of 2,500. The repayment of the loan will have no tax consequence. This is similar to the previous question. So if I think there was temporary difference, I will have done my carrying amount, which is 2,500. I compare that to my tax base, which in this case, the taxman will not capture anything. There is a difference of 2,500, which is again a permanent difference. Is a permanent difference of 2,500. Is a permanent difference of 2,500. So, because it has no tax consequence. Okay, so I'm going to stop the class here for this period. We'll continue in our next period by 8:30. I need you to practice this before then, though I will solve it when I come back, but just practice it before I come. Then When I get back, we'll solve more questions, majorly past questions. Then we'll finish it up on income tax for you guys. Then for the SBR guys, we'll solve more advanced questions on Wednesday. Then we'll also finish income tax with you as well. Thank you very much for your time. I'll see you later in the day. Bye.
Thank you, sir. Please help us drop this note, please. Thank you.
I'll drop it immediately. Okay. Yeah. David, I'm with you. You can ask a question.
Okay. And I thought carrying amount was usually used to refer to assets. And like, why is everything here happening carrying amount, carrying amount?
Yes. So for income tax, that's how we used to express it. The amount we recognize in our books. And if you look at it closely, interest receivable is an asset, trade receivable is an asset, dividend receivable is an asset, loan receivable is an asset. So they are not mistaken. Most of all these items they call assets are actually assets. So being described as carrying amount is okay.